after the Fed shocked everybody with a more hawkish outlook than the markets wanted. That's what's on the mind of everyone looking at what's happening here with Wall Street turning lower, even as we have more tech earnings in the wake. So, are we finally at that point where speculative appetite has given way? We're going to take a look at exactly what's going on and what might be coming in the week ahead. Macro Money starts right now. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And boy, did we have an interesting set of developments here over the past 48 hours. Needless to say, the big story has been the Fed, and it gave markets quite a bit of indigestion. So without spending too much time on a preamble, what we're going to do is dive right into what the results of that Fed shock were and attempt to figure out why it was that it was so shocking, what it did, and what the next big inflection point in this story is likely to be. So, first and foremost, here's what we saw today. And there's a number of interesting standouts here. We have obviously a down day for the sort of big indexes. S&P off almost 1%, NASDAQ off almost 1.5%. Yields up in the wake of what the Fed did and really what Fed Chair Powell did. Crude oil digesting. U.S. dollar up across the board, especially against the yield-sensitive yen. It's not quite as up against the euro, but of course there was an ECB monetary policy announcement overnight. They held rates as widely expected, signaled that really they have no intention of resuming cuts anytime soon. That wasn't exactly controversial. Nobody was expecting them to. In fact, the outlook in ESTR interest rate futures, the equivalent to Fed funds futures for the U.S., had the ECB on standstill through the end of next year. So no big controversy there. The euro bounced a little bit once the ECB confirmed as much, or at least their intent. Since then, of course, it's kind of skidded lower with the general dollar strength. Bitcoin off almost 4%, around sort of this generalized risk aversion, again, doing that whole stocks or risky assets on steroids thing. Wall Street sells off, Bitcoin sells off more. Couple interesting things to look at here. Obviously, this follows from what we saw yesterday. This is the immediate reaction after the Fed. We can see gold was down, dollar was up, Bitcoin was down, yields had a much more spirited jump in the immediate aftermath. Stocks were sort of neutral. And this is where this gets really interesting. Today we can see stocks decided to follow through. No real retrenchment on the yields, no real retrenchment on the dollar. Gold has interestingly perked up. Bitcoin just keeps getting slammed. So the most interesting sort of things in this price action that jump out at me is, number one, what in the world is gold doing up when yields are up and the dollar is up? That's typically kryptonite for gold. Gold is an asset that yields nothing, which makes it inherently vulnerable if yields go up, because why would you own something that yields nothing when you can own something that yields something? So when yields go up, the appeal of owning gold, at least from a speculative perspective, is diminished. Gold is also a kind of alternative to fiat, a kind of natural foil for fiat. The standby fiat currency, of course, the one that matters, the benchmark for all of them, is the US dollar. So when the dollar is up, well, you don't really need an alternative currency. And so when the dollar is up and yields are up together, that's speculative speculative kryptonite for gold for obvious reasons. And yet here we are. So that's one thing. And the other, of course, is that stocks decided to sell off. Now, when we look at the price action dynamics, it probably makes some sense why they didn't decide to do this yesterday. So here's the initial response to the presser with Fed Chair Powell. Note, by the way, this sort of sideways bar before the red one, these are 15-minute bars, by the way. This is the actual FOMC policy announcement. This is where the statement comes out. And the markets very clearly say, yeah, okay, there was two dissents. One of them was bullish, one of them was bearish, or one of them was hawkish, one of them was dovish. Stephen Meehan wanted more cuts. Big shock, comma not. Jeff Schmidt of the Kansas City Fed didn't want any. Okay, so now we know who the resident hawk is. Okay. We got a bunch of language in the statement as we looked yesterday, and I will link that conversation, that episode from yesterday at the top here, so you can check that out. But the language was clearly sort of saying, woe is us, we don't have all the economic data that we need, but the markets didn't think that was really the meat of this. They thought, okay, fine. That's about what you would expect to hear. Just give us our rate cut. They got the rate cut. And then Powell opened his mouth. He got up and to the podium for the post-meeting press conference. And we can see what the reaction was right here. And we'll review in just a second what that reaction was all about. But clearly, I mean, without even thinking about what Powell said, clearly what he said upset the markets. And then the markets sort of reset back to where they started. And that same reset didn't happen in bonds. It didn't happen in the dollar. But it did happen here. So naturally, this kind of begs the question. And when you consider that after the bell yesterday, we had the first kind of big batch of top-tier trillion market cap tech earnings for the week, it sort of makes sense. Why in the world would a market participant want to lean heavily this way or that in front of earnings from Meta, earnings from Microsoft, earnings from Google? These are obviously huge, huge influences on where the overall market is going to go. And as it happened, Microsoft and Google had good results. Meta had a big miss. Microsoft fell anyway. Google rallied. Meta fell more. But that the markets would get defensive, at least as far as conviction goes, and say, you know what, we're not going to commit one way or another to this Fed thing until we see these numbers, that seems to track. But then overnight, you get a big rejection at the top of the range, and then you leak lower for the rest of the day. And this is perhaps where things are really interesting as well, because needless to say, today after the close, we had Apple and Amazon, two other big names. And so if the markets were reluctant to be convinced one way or another after the Fed, one might have expected them to be reluctant to be convinced today, and more so in digestion mode. But that's clearly not what happened. We clearly saw a negative response. I mean, there it is. So there is the gold rally, which seems to clash with what's going on in yields in the dollar. And then there's stocks ostensibly caring about incoming earnings calendar event risk and then not. Well, of course, we'll see what happens tomorrow, but the question stands. What was it that the Fed chair did then, if the markets ultimately decided, you know what, risk off? Here were his comments, and I think very clearly the thing to pay attention to is this last bit right here, where he said, there are different views about how to proceed at the December meeting, strongly differing views. A further cut in December is not a foregone conclusion. Far from it. And there was a really interesting dance that Powell did here. He came out and said, and this is a direct quote, "I always say that it's a fact that we don't make decisions in advance. But this, I'm saying something in addition here. A rate cut in December should not be seen as a foregone conclusion. In fact, far from it." Now, what's interesting about this, of course, is that when the markets went into this thing, they did think that a rate cut in December was a foregone conclusion. And after some kicking of the tires here overnight as the CME Fed Watch tool was adjusting for all of this, this is the accurate new view. So here's the current rate right here. And we can see that going into this, so this was yesterday, the market saw single-digit possibility that rates would remain unchanged and well over 90% probability that we'd get a further cut into this 3.5 to 3.25 range. Well, clearly, this has changed now. And by the way, today is a little bit of an improvement on yesterday's shock response. But we can clearly see the likelihood that we would stay unchanged here has significantly increased. The likelihood that we will get this extra cut has significantly decreased. And of course, that echoes all of the price action that we see. That echoes the lower bonds and higher yields. It echoes the stronger dollar, all of those things. And it seems to sort of track from what the Fed chair and what really the committee was signaling in September if we just take a look a little bit under the hood. Here was September's projection. We can see here from a baseline of 4.4 before September's meeting, because again, the Fed is setting policy in ranges here. So we're looking at medians, right? This is the 400 to 425 basis point range, the 375 to 400 range, the 350 to 375 range. So, and these are single numbers. So the range, the median range before these rate cuts started in September for the Fed funds rate was 4.4, between 4.25, 4.5. Okay, so we get a 3.6 forecast. All right, what does that mean? Well, if we're in a 4.4 range and the number is 3.6, well, that's a difference of 0.8, which is just a rounding off of 0.75, which is 3 cuts at a quarter point each. 25 basis points and 25 basis points and then 25 basis points more. This forecast is issued when we are in September, and the Fed has already issued one with 2 meetings left. October, which we just had, and December. So clearly the markets here are at 3 cuts. Before they were at 2, 3.9. In fact, they held at 2, really since the beginning of the year, even going back to December of 2024, if memory serves. And so clearly we've got the 3 cuts here. That's what the markets had on their bingo card, and the Fed is clearly saying, no. And if we look under the hood, it's perhaps because this is what skewed the outlook. We're only narrowly at a median of 3 cuts. And probably because of this dramatic dot, I'm not saying that's Stephen Mirren, but who else is it? And so I'd love to hear your argument for how that's not him. And so here we are. And so this average gets pulled, or this median rather gets pulled. And you end up with now a serious debate on the committee. In fact, what Powell very clearly says here is that September and October were risk management cuts. And that's not the case going forward. Ostensibly risk management cuts, by the way, because the labor market demand has clearly softened and the balance of risks has shifted to a more neutral stance. So, clearly the Fed is saying December is something different, and whatever debate is implied here is clearly underway. We look at what that's meant for policy expectations, and we can see there's been a steady shift toward a less dovish setting across both the outlook for the rest of this year and the view for next year, most importantly. Now, we can see the way the markets have responded. It would seem that this is starting to give the market some degree of moderate indigestion. So here's this hawkish shift. And again, relatively hawkish. We're still looking for a tons of cuts, more, in fact, than the Fed has told us. At 61 basis points, we are still at least 50 basis points in, which, as we can see from the Fed's projections that we just looked at, is already double what the Fed is saying. They're saying a quarter percent only next year. So the market is already at double that, and 11 basis points in the direction of a third cut. Now, that's now less than even odds of 44% that we get that third cut. It was well over 50 even yesterday. So we're looking at a situation that's less dovish, but dovish nevertheless. The shift that we're looking here is a relative shift. But even with this relative shift, we can see stocks seem to have found some sort of a sticking point here, and they're pulling back. For the dollar, this has been very straightforward. The yields architecture has looked more supportive, so the dollar has continued to go higher. Importantly, though, when that architecture was not looking so supportive and things were getting more dovish, the dollar was still going higher. So for whatever reason here, the dollar is in a state whereby it wants to rise. And that's an interesting observation onto itself. In fact, the dollar hasn't made a lower low since July. Now, probably the most interesting bit here coming up next is whether this part of Powell's conversation is going to materialize. So he says here that data before the shutdown show the economy could be firmer. As a matter of fact, we saw from the S&P Global PMI numbers that were published just last week alongside that special dispensation CPI report, which came out despite the shutdown, that we're back to similar growth levels as were there, again, according to the PMI, in the second half of 2024, which were multi-year highs. So we're looking at a situation where, indeed, it does look like the economy seems to be accelerating. And that, of course, means less scope for rate cuts. So if the markets are responding negatively to that idea, well, then perhaps we're in this kind of good news is bad world once again, where the markets want their cuts. They're suddenly less sure of the Fed's conviction in delivering them. And certainly we can see in the Fed's own forecast, and they increased economic growth projections, they increased inflation expectations, they decreased bets on the unemployment rate. And so the key thing that then emerges as the next inflection point is the ISM manufacturing and service sector numbers due next week. The manufacturing bit is coming already on Monday. If this starts to show us what the S&P global PMIs are showing, because for now it's showing a standstill, as ever in the logic of PMIs, 50 is neutral, above 50 is growth, below 50 is contraction. We're hugging 50. And we're expected to keep hugging it. So if that's what's going on here, then maybe rate cuts have more room to occur because the economy is basically at standstill. But if that's not what's going on, if the S&P global numbers are what is correct, and what the Fed chair is hinting at here is how we end up going, then indeed we could have less room for rate cuts. And that limited scope for easing, if the markets really are now animated by their dislike of that, well, then this downside perhaps has some legs. As a matter of fact, if we look at the way economic data has transpired, such as it has, there's two things to look at here from the Atlanta Fed GDP Now model. Of course, we're still ages away from real third quarter GDP data, and frankly, with this shutdown, who knows if it'll come out even on that timeline. But what we know, as far as we know it, is that the data going into this model has been biased in a positive GDP direction, whereby those things that have entered the model, and this is what makes it a nowcast, is it takes in evidence in real time and updates accordingly. The data that's been going in here has clearly been generally biased towards stronger growth. Moreover, we can see even the consensus forecasts that this thing is tracking, and the Fed alluded to this, certainly Powell did, that's meaningfully improved. So even the consensus forecast now is calling for between 2 and 3% annualized growth. Obviously, the model here is even headier, but what all of this seems to translate into is the data has tended to be growth positive. And if that's the case, well, then rate cuts really do have a significant chance of being wound back even further with this ISM report. And the attention probably is on that ISM report, at least growth data-wise, while the shutdown continues and there's not better data. So, positioning-wise, I am still a bit short gold. I have it in futures form, as well as with a short call vertical here, basically looking for this bounce in gold to fizzle. I think the strange disconnect here with gold rising probably has something to do with a sort of buy the rumor, sell the fact type of a dynamic after the Trump-Xi meeting, whereby it didn't really seem to deliver anything more than what is already, or what was already benchmarked, the kind of shallow suspension of the most recent batch of hostilities. And so gold being a sort of long multipolarity, long siloing of the US and China from each other kind of idea, it's bouncing perhaps because some level of possibility that there would be greater relief than anticipated has been diffused. So in my mind, the bounce still looks corrective. The trend still looks to be pointing down for now. At least the correction seems to continue. And so I'm still a little bit short. I'm long the dollar. I've been long the dollar. I'm still holding that. I'm short against the Aussie, the pound, the euro, and the Canadian dollar. I have a little bit of exposure still short risk via this IBIT Bitcoin ETF. That's obviously working today. I put on some shorts on the S&P through SPY put verticals yesterday after Powell said the magic words. That's tentatively working. We'll see how that goes. Probably the biggest loser today was the bonds, which I'm still long through TLT, but I think the long end ultimately holds up better because the rate cuts will just move down along the timeline. And so I think 30 years or just generally the longer end of the curve looks better than the front. And still a little bit short crude oil after that geopolitical tension around the Lukoil and Rosneft actions from the U.S. seem to fizzle, at least as far as its impact goes. And that's kind of tentatively doing something, but still very early days yet. And that is macro money for today. We're here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, usually looking at the Wall Street close and where things may go therefrom. So that would make this the last macro money show of this week. We'll be back on Monday. I am likewise writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. And, of course, if you're watching this on YouTube and you're following along there, use the comment section. I respond. Like and subscribe. Macro Money is back next week. Happy trading.